One of the biggest challenges in trading is figuring out how to take a big picture view of the market and actually turn it into a concrete plan for today. Well, in this video, we're diving deep into ICT's powerful solution, his complete top-down analysis specifically for short-term trading. We're going to see exactly how a professional takes that high-level bias and forges it into a real daily trading edge. Welcome to AI Explains ICT. We've made it to the final month of the core content, and today we are tackling month 12, episode 3. Seriously, you're going to want to grab a notepad for this one. This isn't just theory, this is the daily playbook, breaking down top-down analysis on ICT's favorite battleground, the short-term time frame. Let's get into it.
So here's our roadmap. First, we'll get into the mindset behind this whole professional approach. Then we'll get crystal clear on the goals of the daily analysis. After that, we'll unveil the complete 9-step framework, the real engine of the system, and break down its most important parts. And finally, we'll see how it all clicks together to define your daily bias, before we wrap up with a summary to make sure it all sticks. Okay, first things first, let's set the stage here. What we're about to walk through isn't just some random collection of trading tips. This is a highly structured, professional method that ICT himself uses, something he's refined over decades in the markets. And ICT is super clear about this. This is not the only way to look at the market, but it is his way. This is his personal trading plan, something he's sharpened over 20+ years. And it's the engine that powers his highest conviction trade ideas. This quote right here, it gets to the absolute heart of the professional mindset. See, the whole point of a structured process like this isn't to find a trade every single day. Nope, it's to build a filter. Most traders feel this constant pressure to be in the market, to always be doing something. But the smart money approach is all about extreme patience, just waiting for the market to come to you and meet your conditions at your levels. Selectivity is everything. So with that professional mindset locked in, what are we actually trying to do here? What are the specific goals of this daily analytical routine?
The entire process really boils down to these 4 things. First, you need to understand the immediate context of the daily chart. What's happening right now? Second, you need to form a clear directional bias. Are we looking for price to go up or down? Third, identify the key levels using PD arrays, those specific price zones like order blocks or fair value gaps that can act as major turning points. And finally, putting it all together for a complete institutional analysis. Every single step we're about to cover is designed to hit these 4 targets.
Okay, so how do we actually achieve those goals? Well, ICT lays out this brilliant, systematic 9-step framework that literally walks you from a 30,000-foot view all the way down to a specific directional bias for the day. And here it is. This is the engine that drives the whole analysis. This is the roadmap. Just look at how it starts at the macro level with commercial hedging and then systematically drills down through institutional order flow, market structure, all the way to key price levels. Each step refines the view, leading to that one final product, a single defined daily bias. It's like an analytical assembly line for high probability ideas. Let's just follow the logic here for a second. We start with the biggest players in the game, the commercial hedgers, to get that macro perspective. Then we narrow in on institutional order flow to see where the smart money is actually putting its weight. From there, we frame that idea within a weekly profile and confirm it with intermarket analysis. And then finally, we zoom right into the chart itself, analyzing market structure and mapping out those PD arrays to find our exact levels. It's a funnel, really, moving from the big picture down to a specific actionable setup. All right, now let's roll up our sleeves and really dig into some of the most critical components of that framework. This is where the theory becomes practical. So the analysis kicks off with the Commitment of Traders Report, or COT data. But ICT has this really unique way of reading it. First, you look at the last 12 months of the commercial's net positions. Then, you find the absolute highest high and the lowest low within that 1-year range. And here's the trick. You visually slice that range in half, creating a new zero line. If their current position is above that midpoint, that's a bullish signal. If it's below, it's bearish. Simple but powerful. Next up is open interest. But, and this is a huge but, it only matters under very specific conditions. For a bullish signal, ICT is looking for open interest to drop by 15% or more while price is sitting in a higher timeframe discount array, an area where price is basically on sale. For a bearish signal, he's looking for a 15% or more increase, while price is in a premium array where it's expensive. Here's the key. If those specific conditions aren't met, you just ignore open interest completely. It's a critical filter.
Okay, now we get to what ICT calls the single most important component in this entire framework, institutional order flow. Why is it so important? Because this is where you see the footprints of smart money. It's all about watching how price respects previous daily candles. If we're bullish, old down-close candles should act like a floor. If we're bearish, old up-close candles should act like a ceiling. He says that if you ignore this, you're basically playing Russian roulette with your account because you have no idea if the big institutions are even on your side.
The next layer is forecasting the weekly profile. You're essentially trying to predict the likely shape of the week's price action. And the key insight here is that the main move, the bulk of the expansion for the week, usually happens between Tuesday and Thursday. Your best friend here is the economic calendar, because that's what will often trigger those big moves. Now, to frame this weekly analysis, ICT uses two very specific opening prices. First, the natural Sunday open, and second, the Monday midnight opening price based on New York time. You draw both of these lines across your whole week. They become these crucial reference points for the power of three concept, where we expect a pattern of accumulation, a fake-out manipulation move, and then the real expansion for the week. At this stage, intermarket analysis gets really focused. The whole goal is to hunt for SMT, or smart money technique divergence. Think of it like a crack in the system. It's when two assets that are supposed to move together don't. For example, the dollar index makes a new high, but a correlated pair like the euro fails to make a new low. When you spot that on the daily or 4-hour chart, it's a massive confirmation that your bias is likely correct or a huge red flag that it might be wrong.
When we get down to market structure, the focus narrows in on one specific pattern: daily breakers. And why is that? Because the range between a bullish breaker and a bearish breaker often contains incredibly clean, one-sided institutional order flow. Trading inside these specific zones can dramatically increase the odds of catching a powerful directional move. So, after working through all those different analytical layers, we finally arrive at the last step, taking all that information and synthesizing it down into one single, defined directional bias for the day. And honestly, this might be the most important professional lesson of all. Just because you have a bullish bias doesn't mean you're a buyer every single day. Just because you're bearish doesn't mean you're hitting sell all the time. A bias is just a directional expectation. You are still required as a professional to patiently wait for the price action to actually align with what you're expecting. So what does a defined bias really mean in practice? It's not a wild guess. It means you know your direction, and then you have the discipline to wait for price to trade down to one of those specific PD arrays we talked about, into a discount area for a buy or up into a premium area for a sell. It's that perfect storm of the right price at the right time with the right bias that creates a true high probability setup. All right, let's bring it all home and recap the entire process into a clear final checklist. This is your path from start to finish. So let's run through it one last time. You start with the big picture. What are the commercials doing? You check for those very specific open interest conditions for confirmation. Then you find the real institutional sponsorship by analyzing the order flow. You frame your week with the weekly profile and use SMT divergence as a reality check. Finally, you zoom into the daily chart, you find those clean ranges between market structure breakers, and you map your specific PD arrays to pinpoint your entry levels. This whole sequence is designed to take you from a general feeling about the market to a precise, actionable trade idea. If this breakdown was helpful for you, please do us a favor and like this video and subscribe for more deep dives into ICT's concepts. If you have any questions at all, drop them in the comments below and an actual human will get back to you. And as always, safe trading.